You press buy at 50. But 50 is not necessarily what you pay, and the chart moving your way does not guarantee a good result. Between the button and your money sit four things: the order, the market available to fill it, the trading costs, and the position size. That is the model every new trader should understand before risking money. Trading is not simply faster investing. A long-term investor usually works toward a goal over years, using regular contributions and diversification. A trader makes a shorter horizon decision with a specific entry, invalidation, and exit. Execution and risk control therefore carry more weight. Neither process guarantees a profit, and trading is not suitable for everyone. Meet Ari, a fictional beginner watching a generic instrument around 50. The last traded price looks like the purchase price. But the order travels through a broker to an execution venue. Prices can change, and the quote covers only the quantity available. A market order prioritizes execution, not price. A limit order sets the highest buy price or lowest sell price. That controls price but may never fill. A stop order waits for a trigger, then usually becomes a market order. The trigger is not a guaranteed exit price. A fast or thin market can feel worse. Inside the quote, the bid is what a buyer is currently willing to pay. The ask is what a seller is currently willing to accept. Their difference is the spread. And crossing that spread is one cost of immediacy. In a liquid market, many orders sit close together, and a modest trade may fill near the quote. With fewer orders, it can travel through several price levels. The gap between expected price and actual fill is slippage. Rising volatility can shrink depth and widen spreads. So Ari can be directionally right and still get a disappointing outcome. The market rises after entry, but Ari paid the ask, received a worse fill, later sold at the bid, and paid fees on both sides. Spread, slippage, and fees absorb part of the move. Direction is only one part of the result. Now connect execution to risk. Before entering, Ari writes down the planned entry, the price that would invalidate the idea, the maximum hypothetical loss Ari is prepared to accept, and estimated trading costs. In our illustration, the entry is 50. The invalidation level is 48.80, and estimated fees plus slippage are 20 cents per unit. The price risk is 1.20. Add the estimated costs, and the planning risk becomes 1.40 per unit. Ari's hypothetical account is 10,000, while the editable maximum loss amount in this example is 120. Divide 120 by 1.40 and round down. The planner allows 85 whole units. That creates notional exposure of 4,950 and an estimated loss of 119 if the assumptions hold. Notice the order. Ari did not choose a position and then place a convenient stop. The invalidation level came from the idea. The maximum loss amount constrained the position. If the stop must be farther away, or estimated costs rise, the position becomes smaller. And 119 is not a promise. A market can gap past a stop, an order can fill in pieces, or liquidity can disappear. The realized loss can be larger. Leverage makes this more important. Margin may control 4,250 of exposure with much less cash, but the risk does not disappear. Leverage magnifies gains and losses, can trigger margin calls or forced closing, and, depending on product, account, and jurisdiction, losses may exceed the initial deposit. Some retail products have negative balance protection, others do not. Check the exact rules. Before real money, write the entry condition, invalidation, order, estimated costs, and maximum loss. Record the actual fill, exit, costs, and result. Practice in a reputable simulator or paper trading environment, remembering that simulation cannot reproduce every live fill, fee, delay, or emotion. 3 points to keep. Your order balances speed, price, and certainty. Spread, slippage, fees, and liquidity can change the outcome even when direction is right, and position size should follow the invalidation level and maximum acceptable loss, not the other way around. The free Finance 101 Trade Risk and Position Size Planner lets you test those assumptions without giving you a trade recommendation. Use it to expose the numbers, not to pretend the uncertainty has disappeared.